Good morning, and thank you for attending the latest presentation from the Austin Associates webinar series. Today's topic is loan growth strategies for highly competitive markets. My name is Andy Morgan, and I am joined today by Jeff Morris. Both Jeff and I are principals and managing directors of Austin's Financial Management Division. I just want to go through a few housekeeping items before we begin today's presentation. All participants will be muted during the webinar. All participant names are anonymous to other webinar participants. If you have any questions, they should be typed into your GoToWebinar participant control panel. We will respond to questions at the end of the session. If we are unable to get to your question due to time constraints, we will respond after the webinar. If you are having any technical difficulty during the presentation, you can try contacting Lisa Cordier at our office. Her direct line is 419-517-1763. I'll give that to you one more time. Lisa Cordier, 419-517-1763. And lastly, the webinar is being recorded and will be available on both austinassociates.com and the Austin Associates YouTube channel, within an hour or so after the conclusion of the presentation. You will also be able to download the presentation slides from our website. I'd like to share just a few brief comments about our firm. We have been providing consulting services to financial institutions for over 50 years. We have a relationship-based consulting business with 4 practice areas. We serve financial institutions of all sizes located across the country. Last year, we worked with over 200 clients in 26 states. You can find more information about the range of services we provide on our website, austinassociates.com. So today's webinar, the agenda that we've laid out, Jeff and I are going to spend the first 10 minutes or so going through some of the challenges and opportunities and trends that we see heading into 2016. After that, we'll spend the majority of today's session going through various growth strategies Jeff and I have identified, and I'll walk through those with you guys. So there's a list of them on the agenda for your reference. So the first few slides I'm going to go through, and really what we've gathered is the results of some surveys that different companies have put out there over the last, I'd say, 6 months. The first slide here was based on a survey that was done by Bank Director. And the question was, how does your bank plan to grow within the next 12 months? And you can see by the results of this bar graph, the biggest response to that question was organic loan origination. So that's really kind of the driving force behind what a lot of bankers are feeling is a big opportunity over the next 12 months going forward. Within that segment, those respondents were asked, what portion of the loan portfolio do you feel you have the greatest opportunities to grow? And we're going to be talking heavily today about commercial real estate, C&I loans, and you can see that was the biggest percentage of the respondents there. The next couple slides come from a survey that was performed by CSI, Computer Services, Inc. This was performed at the end of 2015. And this kind of shows you results of their survey from both 2015 and then some changes for 2016. But the question on this slide had to do with the greatest challenges going into 2016. And you can see for both 2015 and 16, the biggest response was driving growth and profitability. Now, obviously, there are other issues that are coming to the forefront in terms of compliance and other areas like that, but driving growth and profitability still leads in terms of the responses on that chart. On the flip side, the greatest opportunities going into 2016, this was kind of a repeat from 15 to 16. It was really driving interest income and loan growth. So while that can be a challenge going into the year, a lot of bankers feel that's still the biggest area of opportunity as they head into this year. The next 4 slides come from a survey that was done by the Federal Reserve. It's their Senior Loan Officer Opinion Survey. This was released just last month in January. The way that these charts are laid out, you can kind of think of the 0 line as the break-even point. Anything above 0 would be the majority of respondents would answer the question in an affirmative or positive manner. Anything below that zero line, a bigger percentage answered on the flip side of that. So this first one is talking about credit standards and tightening of credit standards. And you can kind of see the peaks and valleys throughout the last 10 or 15 years. Obviously, during the recession, credit standards increased significantly. There's been a little bit of easing on that, kind of from 2010 up until the end of 2013 and 14. But the big thing to point out on this slide is credit standards are starting to tighten again over the last few quarters, and the forecast going forward into 16 on commercial real estate is those standards are going to continue to increase. We saw similar results when you look at C&I type loans, and some of the reasons in terms of why bankers are feeling credit standards are starting to tighten. You can see those listed at the bottom. Obviously, the uncertain economic forecast going forward, industry-specific problems, a lot of problems related to the energy arena, and then just an overall reduced tolerance for risk. A lot of bankers are maybe a little shell-shocked from the Great Recession period, and have increased credit standards in accordance with that. Then the last slide I want to go through before I turn it over to Jeff here, last couple slides, is the actual demand for CRE and C&I loans. You can kind of see the peaks and valleys here. Demand for these types of loans has really been on the increase since 2009 up until the recent time. And then, going through 13 through 14, there was a little bit of decrease in terms of the respondents, but at the end of 14, we saw another little bit of a peak in terms of increase in CRE demand. But as you see at the end of this graph, according to the survey respondents, the forecast going forward into 16 may be a little bit of a decrease in demand on these types of loans. And you'll see the similar type scale here on the C&I graph as well. I won't go through the bullet points at the bottom, but there's some of the rationale that came out of that survey in terms of what the senior lenders were feeling in terms of loan demand.
Okay, well, this is Jeff, and I'm going to talk a little bit about the actual commercial banks' loan portfolios that we're trying to grow by the strategies we're going to be talking about for the majority of the webinar this morning. And what I'm doing here is contrasting both the size and the concentration of the portfolios at what we define as community banks, which is $3 billion and under. When you compare various statistics for the commercial bank industry, different people define community banks different ways. Our definition is $3 billion and less. So when you're looking at the larger, and we do have some larger banks with us on the webinar today, as well as many credit unions, but mostly I think we're community banks in that size range. The concentration or the diversification of the portfolio at the larger banks, it's more balanced across four categories. The commercial loans are shown there at the bottom, residential mortgages as the next piece, and then consumer and that kind of catch-all category of all other. The larger banks are much more diversified across those categories than our community banks in general. So you've got about 13.5% of the market, about 1.1 trillion in total loans in the community bank segment versus about 7 trillion in the larger commercial banks. On the community bank side, it's really very heavily concentrated in commercial and residential loan portfolios. Not a lot in consumer or others. Another way of looking at this is kind of looking at it as a percentage of the total portfolios. At our community banks, much more dependent on the commercial loan side, with about 68% of the total portfolio being involved in that segment. The larger commercial banks have diversification in consumer and other loan types, which include loans to states and political subdivisions, and loans to banks. Community banks don't really get involved in that much, and they also have a much weaker or much smaller asset allocation to consumer lending. So being that we're much more reliant in the community bank sector on commercial loans, we wanted to get a little bit of an understanding of what the profitability of that loan portfolio is. And to do this, we took the population of Austin Associates profitability client base. We have a moderately sized group of community banks that we work with here. The asset allocation within our client group, for whatever reason, is a little bit different than what we saw on that prior slide. Our community bank clients are a little bit more diversified, a little bit less concentrated into the commercial loan portfolio, more mortgage loans, more consumer loans, more other loans than what we looked at a moment ago. But still 21 to 55% of their total assets are invested in commercial loans as defined here. And what we observe from a profitability standpoint is that it's actually driving between half and in many cases even more than total bank-wide profitability, all the way up to 162% of bank-wide profitability coming from commercial loans. And the ROEs on these product types range from the low 2s to the mid 3% range. When the bank-wide average is at 1%, commercial loan portfolio is doing 2.5 to 4.5 times the level of profit return as measured in ROA. In ROE terms, and these are important numbers here to have an idea of the range of ROEs of the commercial loan portfolios. Within our client base, it ranges from 11, mid 11 up to mid 18% ROE. That's important because that's going to be the range you're targeting for your new loan portfolio additions. And that compares to 9% bank-wide average. So it's about 2 times the ROE of the bank as a whole. So let's look in more depth at the commercial loan portfolios themselves, separate from the whole portfolio. At larger banks, this amounts to about 2.7 trillion in total loan portfolios, and you can see how it's spread out there between C&I loans. That's the dark blue segment of the bar at the bottom, and CRE loans, which is the lighter blue shaded segment. Larger banks have more C&I loans, less CRE loans, and then again, this kind of shows the disparity at the community banks, much more reliant on commercial loans, commercial real estate loans. So to look at that again in the full percentage breakout, 46% of community banks' loans are CRE loans, and only 22% are C&I. I know a lot of the community bankers that I talk to would like to have a greater concentration in the C&I loans, but it's just very, very tough to get given the dominant position that the larger community banks have. So let's look at this is a couple different ways of looking at the growth in those segments of the overall commercial loan portfolio over the last 5 years. The blue bars here to the left in each segment are really looking at the growth from 2011 through 2015, and the overall growth was 2% in that time frame. Across the last 9 quarters. That's the green bar. It was a negligible, less than 1%, just 0.83% growth across the last 5 years, but it's been doing a little bit better over the last 9 quarters, up 2%. Interesting to note that some of the smaller categories in the middle there, C&D, construction and development loans, have grown very significantly in the last 9 quarters, and also the 2 segments that make up the overall ag portfolio, farm loans and ag product types, have grown much more rapidly than the total. Multifamily has been growing well, and C&I has been growing a little bit better than CRE, but CRE in this segment has actually been relatively flat, and I think that's going to make the challenge all the greater as we try to look to that segment for large pools of growth in 2016. We do have a number of credit unions that have joined us today, so I didn't want to overlook their information. Credit unions is, for the most part, are much more concentrated in real estate loans, residential real estate loans, and car loans, vehicle loans. They've also been growing member business loans at a fairly good rate. The credit union industry as a whole has grown faster than the community bank industry. On a one-year growth rate, 2014 to 2015, they actually grew about 10.5%. The member business loan segment of that grew at about 12.4%. It's now up to about $60 billion. That relates to all of the commercial loans in the community banking industry. That's the $3 billion and less. That equates to about 8% of the commercial loans at community banks. So growing at a faster rate, but a very small component. So I think it probably is fair to say that a lot of the strategies we're going to start talking about in a few minutes would apply to the member business loan segment for you credit unions that joined us today, but primarily focused on our community banks. So we're going to start getting into some of the growth strategies we see our clients deploying successfully, and most of them are really aimed at one thing, and that's trying to create a favorable mix variance as we go from year to year. So we've started with a scenario here we think is applicable. $550 million asset bank that has a currently existing loan to asset ratio of about 60%. So they're in a position where they would very much like to grow the loan portfolio, change that loan to asset ratio, tilt it to the higher earning loan portfolio side. They're currently earning an 80 basis point ROA. For sake of the assumption here, we are using an industry standard of about a 40 basis point provision for loan loss. That's the community bank standard for the last 3 years on average. We're assuming a tax rate at 34%. And the assumption here to demonstrate the power of a mix variance is that this entity, this community bank, is going to try to grow their loan portfolio by $30 million. Certainly they have the liquidity and the funding capability to do that. So starting out, they have $330 million in loans, $140 million in investments, and the balances are in non-earning other assets. The loan yield is 4%. This is, again, just for the sake of the example. And the investment portfolio is earning 195. That gives them an overall earning asset yield of 290. That's fairly low for current times. That would produce an after-tax profit of $4.4 million, and it would give us our ROA of 80 basis points. So a year later, if you were able to successfully implement this strategy to grow your loan portfolio by $30 million, that's a 9% growth in the loan portfolio, starting out at $330 million, moving to $360 million. What that means is that the investment portfolio is going to shrink by a complement of $30 million. And what we did here is we made a very conservative assumption. What we feel is a conservative assumption is that to get that level, 9% growth of $30 million, we lower the loan rate to 3.75. Now you may not need to do that, or you may not be able to do that, depending on your market and your market position and how competitive other banks are in your area. But to show the power of this strategy, we wanted to use a very conservative number. We felt the 375 was pretty conservative. What happens is the loan yield falls to 398, and the overall earning asset yield rises because of the mix change from 290 to 299, almost 3%. We recognize an increased provision for loan loss expense of $120,000 on the $30 million of new loans, and our after-tax profit under this strategy would grow by about $280,000 to $4.68 million, and we get a 5 basis point improvement in ROA as a result of that. Now, that might not seem like a lot to you while growing your loan portfolio 9%. by $30 million might be a very, very difficult task. Given these conservative assumptions, it still has a 5 basis point positive impact to the bottom line of the institution, and that demonstrates the power. If you can do it at 4%, if you can do it at a higher rate, if you can do a larger balance, it can all be stronger than that, but it demonstrates the power of the mixed variance.
Okay, so let's dive in a little deeper now and actually get into some strategies to help you maybe accomplish that growth goal. You know, Jeff talked about a $30 million example of growth over the next year. You know, one of the first places you might want to think about starting is cultivating existing relationships. And what we mean by that is, some of your greatest opportunities might lie within your existing customer base. So a lot of times when we're working with clients that are using our profitability services or loan pricing services, we're going to be able to present them with reports that allow them to analyze their existing loan portfolio for profitability. And by doing that, they're able to give each of their lenders a detailed profitability report of their existing customer list. And then within that customer list, they're going to be able to identify opportunities. An example I'm going to go through here in a few minutes on the next few slides, we're going to show you an example of how you may be able to identify customers that have very significant balances with you, but based on the profitability metrics and the profitability of that customer might not be currently hitting the ROE targets of the bank. Okay, so these might be customers you want to identify, ones that you want to proactively engage with, determine if they have either other borrowing needs or maybe you have other services at the bank, fee-based services, cash management services, treasury management services, things like that, that might allow you to grow that relationship and take those significant customers from lower levels of ROE and move the needle in a positive direction. So to show you an example of how you might go about doing this, this is an example of one of our reports, but you can really do this analysis through other third-party services. You might have something internally developed where you can come up with profitability on a customer-by-customer basis. But within this report, what we do is we identify the customers in red here as customers that have larger than average balances, but lower than average current levels of ROE. So again, these would be customers that you might want to proactively either reach out to, or when they come in the door the next time looking for that additional loan, that you want to make sure that you price it appropriately in order to move their ROE in a positive direction. So the customer I've highlighted at the bottom, what we see here is their total average balance with the bank is about $1.9 million, and we're going to see what that is composed of here in a minute. But at the very far right of this schedule, the current ROE of this customer is an 11.2%. So if you dive a little deeper and take a look at what makes up that existing portfolio, what we see here are two existing accounts, one being a commercial loan, one being a business checking account. Obviously, the commercial loan has the bigger balance there, $1.8 million balance. The checking account has an average balance of $60,000. So those are the two accounts that are making up the existing portfolio. If we look at the current ROE levels of those two accounts in the blue box in the top middle there, that's where we see an 11.2%. So the question is, how do we go about increasing the profitability of these customers? Well, maybe you find out through either talking with the customer or doing financial analysis on their customer as part of your underwriting standards that they might need an additional operating line of credit. Let's see what the impact that might have on this customer's profitability and how that's going to maybe grow our portfolio at the same time. So I'm going to price out a $1 million commitment. We're going to assume the average balance or average usage on that line over the 12-month commitment period is $625,000. And what we see with our profitability results boxes at the top is if we were able to add this line of credit into this customer's portfolio, the ROE on this customer is going to grow from 11.2% up to over 13% ROE. We see that in the top right box. At the same time, we've also deployed part of our balance sheet into loans. So we've grown our loan portfolio at the same time. This customer relationship went from a $1.8 million relationship up to about a $2.5 million relationship. So that, if you have excess liquidity on your balance sheet and you're trying to grow loans, this would be one way you can go about doing it.
So the next strategy we're going to talk about is using participation loans to expand the bank's lending field and perhaps to serve larger clients in your market area than you've been able to serve in the past. And the basic strategy, I know a lot of banks are currently involved in participation lending. You might just look at that area and see how you might expand your involvement there. If you've originated and then participated out loans in the past, you might want to do more of that in the future. If you haven't done that, you might want to begin doing that. If you've been a buyer of participations from other banks, either in your state or geographically diversified from your market area, you may want to look at either starting that or doing more of that because of the impacts that participation lending allows you to get involved in. We have awareness of various states in our practice area where there's consortiums of banks that have gotten together either formally or informally and have agreed to work together to grow their participation practices, whether on the buy side or the sell side. So you might want to consider doing that. Let's look at the impact that has, the potential that has for your loan portfolio. We're going to look at two options here. On the left side, it's a $1 million, just a standard in-house commercial real estate loan. Let's say it's at a 7-year fixed rate commitment at 4.25. The ROE on that loan is about 14%. If you come across an opportunity in your market area, it might be the kind of thing that you've not been able to really service in the past because of your legal lending limit. It's organization side and a bank loan request larger than what you've been comfortable dealing with in the past. You might want to consider potentially serving that customer's need jointly with some other institutions. There are many institutions out there in similar circumstances that are looking to grow their loan portfolio but don't have demand within their own market. So it gives you an opportunity to make the loan and participate it out. Let's assume that we participate out 80% of this loan. And that could be to a single buyer, it could be to multiple institutions. So we end up net with still $1 million loan on our books, but you're taking a 25 basis point servicing fee on the $4 million that you're participating out. The ROE on that overall relationship or that overall loan rises to above 21%. So because of the sweetener, if you will, of that 25 basis point fee on the $4 million that you participate out, that can be a very good strategy for you.
Okay, so obviously we've been hearing over the last few years, given the rate environment that's been out there for an extended period, a lot of customers, a lot of borrowers are trying to lock in rates for longer terms. So as you're thinking about strategies and growing your loan portfolio, obviously a thing to keep in mind is being able to manage that extension risk. So like I mentioned, a lot of borrowers are looking for 7-year, 10-year fixed rate loans. Even looking for longer amortization periods as well. So those are all the things you want to take into account when you're kind of looking at loans and looking at the ROE and profitability on those loans. What we've heard talking to clients and sitting in on various lending forums is oftentimes borrowers are willing to shorten the term or shorten the fixed rate period on that loan. So you might want, through your negotiation process, to try to lock those customers that are looking for 10-year loans, propose something along the lines of a 5-year fixed rate, 5-year adjustable period with a 10-year balloon. We're hearing from a lot of our clients that oftentimes that's sufficient to their borrowers. So showing an example of, the profitability implications of those two loan structures. On the next slide, we're basically looking at that $1 million CRE loan again. On the left side, we're analyzing it with a 10-year fixed rate term and a 20-year amortization. On the right-hand side, it's the other situation where we're just going to lock the rate for 5 years, still have a 10-year balloon on there and a 20-year amortization. So if we model everything else being the same, in order to achieve a 15% ROE on these two different loan examples, you can see the differences in the rates required. And this is strictly due to the fact that on the 10-year fixed rate loan, by extending the term that long, you're going to get hit with a lot higher cost of funds on that loan. So it's going to take a significantly higher loan rate to achieve that same 15% ROE. Whereas on the 5-year fixed rate, we'd be able to lower the rate by 84 basis points down to 4% and still maintain that 15% ROE. So term definitely has a big impact on profitability. And as you're growing portfolio, you definitely have to keep that in mind, both from a profitability standpoint as well as an interest rate risk standpoint.
So the next strategy we're going to talk about is one we refer to as gathering commercial deposits. And in a way, it's kind of similar to the cultivating existing customer relationships that we talked about before. It's just a little bit of a variant off of that. And basically, there's an awareness that some percentage of your existing borrowers, they're very good loan customers, but their primary checking account may not be with your institution. Banks traditionally have done a pretty good job, I think, of if we make the loan, we're going to be your bank, we're going to hold your checking account. But still, there is some segment where you're missing out on the opportunity to be that primary financial institution overall. And you should develop both an awareness of what those percentages are, what percentage of clients are we not the primary financial institution for when we make the loan, and have a list of the ones that would really be your target for this strategy. How do we go and gain that primary checking account relationship and move it to our bank? So there are benefits to the customer as well as to the bank out of this. The benefit to the customer may very well be that they have a lower loan rate as a result of having the full relationship with your bank. And we've talked about this for a long time and really can't see any significant downsides to the bank of this strategy. So the example that we want to look at here is a $500,000 commercial real estate loan customer that currently has, we're going to call it no deposits. It doesn't literally mean no deposits. It just might mean lack of the primary checking account with your bank. And let's assume that they're paying 4.25% rate for a five-year fixed rate loan. What you find on that is that it's about a 14.64 ROE. We've kind of got that in the cautionary zone. It's below our 15% ROE target. And if we can bring over even a moderately sized checking account that we don't currently have with this customer, $50,000 in the current example, and we add that to the portfolio, not necessarily a huge pickup in either ROE or dollars. It does move the ROE on this overall relationship up above our 15% target, brings us up to 15.5. But probably the benefits of this are a little bit more, just related to the fact that now we have a relationship with this customer that's a lot more durable, and we've also picked up $50,000 of additional funding. So we've gained that, and if you picture that being done across a pool of commercial clients, that adds up to being significant funding available to fund other loan growth. So we think that's still a practical, doable strategy.
Okay, so a lot of these examples we've been talking about, we've been kind of referring back to ROE, the ROE metric and ROE targets. One thing you're going to want to get a handle on if you don't already have this in place is what are the appropriate targets that you should be trying to shoot for as you're, growing your commercial loan portfolio. And Jeff's going to get into a little more detail on a few more slides here about proper pricing and things like that. But I just want to explain just for a few minutes here the process we go about when we help clients set the ROE targets within a pricing model they might have. Because obviously as you're growing portfolio, it helps you to have a benchmark you're trying to hit, not only so you're not losing out on opportunities in terms of maybe pricing out of the market, or maybe even underpricing on the flip side and not achieving the ROEs that you need to hit. So what we normally recommend is you want to analyze your existing portfolio, determine what the current ROE levels are of each of the individual products within that commercial portfolio. So there are a lot of things that are going to go into analyzing that portfolio. You want to make sure you include all the appropriate assumptions. You're allocating costs. You're applying a funding curve to come up with the cost of funding on the existing portfolio. Obviously, we're going to allocate provision expense out, pick up fee income, things like that. And then at the end of the day, make sure you're allocating capital appropriately. I'm going to dive into that a little bit deeper here in the next couple slides. After you analyze the portfolio, and you come up with what those current ROE levels are, the next thing you might want to think about is segmenting your portfolio into different loan size tranches. What you're going to see is loan size has a big impact on how ROE is calculated. So a lot of times the target you're going to set on your large commercial loan opportunities is going to be different than the target you want to set on your typical or maybe smaller than average loan sizes. And we'll see the impact of that here in a few slides. So here's an example of an analysis like this. It shows the commercial portfolio broken out into the various product types. When we do an analysis like this, we always look at the number of accounts, come up with average account size, things like that. But the last couple columns on this slide show the net interest margin level. So the credit for funding column, you just think of that as the current yield on those portfolios. The interest expense and the cost of funding field, that's made up of the current cost of funding on those individual portfolios. So that goes back to looking at the term of those loans, as well as either the origination date or maybe the last reset date on those loans in order to assign an appropriate cost of funding to those loans. So shorter term products are going to have lower cost of funds. The higher term, longer term products are going to have higher cost of funds in general. So that slide's kind of continued to finish the income statement on each of these product lines. We get a net interest margin calculation. The next columns pick up how we allocate expenses. So we look at the total non-interest expenses of the institution. Those get allocated out to the loan products, deposit products, treasury management area in such a way that all costs that your institution has are going to be allocated out to products. So that column picks up both the impact of your expenses as well as provision allocation. And at the end of the day, what you're going to end up with is a level of profitability and a level of ROE for each of your product lines. And a lot of times what you're going to want to do is you're going to want to repeat this calculation on a routine basis. For our clients, we do it quarterly. You might want to do it monthly. You might want to do it a couple times a year. But what that's going to allow you to do is track performance over time. So you're going to be able to compare the current ROE levels of your individual product lines versus where they were maybe a quarter ago or maybe a month ago, and see if those ROEs are going up or down. So this gives you the total level of ROE on the product level. But like I mentioned a few minutes ago, the best way to set targets, and I'm going to skip through the next slide because I've kind of talked about how we're going to determine those targets, is to break that portfolio apart now into different tranches. So what we've done in this analysis is you see three different tranches. We have the loan portfolio broken out in terms of loans less than $250,000 in size, loans that fall between $250,000 and $1 million in size, and then those loans over $1 million. And by doing that, you're going to be able to see the current return levels of each of those products within each of those tranches. And that's going to help you set the appropriate targets to use in a pricing model process. So a lot of times what you'll see is on that smallest loan size tranche, return levels aren't going to be as high as they are on the larger size loans, and you're going to adjust those targets accordingly. A lot of times what we recommend is to have a minimum target within your process. So if you have current products, especially in that smaller loan size tranche that are have single-digit return levels. Come up with a minimum ROE target that you might want to apply to that particular tranche. And then obviously, as the loan sizes get bigger, you see an increase in current ROE levels, and the ROE targets adjust up accordingly.
So closely related to the idea that Andy's just talked about in determining appropriate ROE targets is the idea that if your pricing that you're presenting to the market is appropriately calibrated, you're assuring appropriate pricing, that is going to have a very favorable impact on your ability to gain new loan volume in highly competitive situations where you're maybe out there bidding against a non-traditional lender, another community bank that's hungry for loans, perhaps a branch office of a large regional or national bank that competes in your marketplace. So we understand it's a very competitive marketplace out there. To assure that you have appropriate pricing for your market, for your bank, you not only have to be able to determine your ROE targets appropriately, but you need to be able to bring pricing to the market that's going to match your situation. So there's kind of a scale out there, and I think the differentiation between what's safe and what's in kind of cautionary pricing levels, it's really determined in a small number of basis points, if you will. If you're implementing your pricing strategy in a way that's sort of um, the historical way we've always done business, maybe you're using some type of a rate sheet, maybe you're using a loan pricing tool, but maybe it's not highly accurately calibrated. You can create some situations, and we've heard of these happening in the marketplace. People have come to us and said, well, we implemented a loan pricing model, and our lenders came back to us and said, we can't make loans using this thing because we're out of the market. And when we hear that, we generally know pretty much exactly what the problem is. There's a single numeric ROE target being used, and that target is too high. It's been set in a way that fairly arbitrary and not necessarily connected to what the current returns of the existing portfolio are. So, we want to help our clients kind of get to that safe zone in the middle. Where is the appropriate level of pricing? And this is a general item, a general consideration, as much as it is a consideration for every individual customer that you might be working with. Unique to their product mix, unique to their account size. So to assure appropriate pricing, there's a number of ways that institutions try to do this. The use of rate sheets is one. Using a loan pricing system like the one we provide, Loan Pricing Pro, is another. It's very important that those systems be appropriately calibrated so that they match your loan portfolio and your marketplace. And other institutions use profitability systems. And again, we have one of those that we provide for a large number of clients. It expands the array and the accuracy, improves the accuracy of the pricing that you're able to do, that takes into account product profitability and customer profitability, and allows you to get very specific with your loan officers, giving them the information they need to manage this pricing question. The problem that we see with institutions that are only using rate sheets is it's kind of a one-size-fits-all approach. It doesn't really easily allow you or accurately allow you to take into account differences in loan size. And it's not profitability based. It's typically not ROE based. It doesn't take into account all of the other business the customer might have with you within their relationship, and just kind of tends to be sort of a blunt tool. It's not really as accurate as you'd like to be able to use. So some of the benefits of going to a loan pricing tool is it really gives you the ability to provide guidance, and I really want to think about that in terms of general guidance. It's not a mandate that you hit a certain target, and your targets might be ranges as opposed to single numeric targets. and your targets should be differentiated for both product type and loan size. So it gives you the ability to get very specific in that. Gives the client the credit for other business that they might have with the bank, and then it also lends support to the negotiation process where you have the ability to say, what if the rate is increased or decreased? What if the term is changed, made shorter or longer? What if fees are added? What if other business comes in, whether it's other deposit-based business or other fee-based business? You can bring all of those things into account and have very accurate pricing appropriate to the relationship profitability of each individual client. So what it really allows you to do is each time you're making a new loan within a new relationship, you're able to put in front of your lender, here's the actual profitability of this relationship. We can talk about what the appropriate level of target ROE should be. We can slide that up or down a little bit on a scale. We can play with the small changes in rate or small changes in fee or term that guide us to these numbers, but you have a very objective process that helps you get where you want to go. And then the other thing you're able to do is you're able to help your lenders by giving them a scorecard that tells them exactly how they're doing on the. Each lender can not only see the change in the size of their portfolio period to period, they can see what the yield is, the credit for funding percentage. There's the yield column, how much fees they're collecting, what provision expense they're being charged with, and what the ROE is of their portfolio. Period to period. How's that changing? And to be able to rank order all of the customers within that portfolio in descending order of ROE, it really is giving them the tools that they need to be successful and to improve the profitability performance of their portfolio as they grow those portfolios. So those are we've kind of covered well, I guess there's one or two more points on this slide related to that. When we're sharing individual customer rankings of ROE with each individual lender, so that they know what's in their book of business, some of the things they're able to drill down into is understanding who their top 10 most profitable relationships are, the ones that they must retain to hold the profitability of their portfolio. They can see the bottom 10 least profitable, the ones they must improve. You don't want to kick those customers out of the bank. You want to improve their relationship so that your costs are being spread over a larger number of relationships, and that your size and ROE are improving at the same time. And then there's other relationships that you're able to focus on the larger relationships that have lower ROEs and come up with strategies to improve those as you go forward. So that's kind of the end of the specific strategies that we thought were most important to talk about individually. Now, kind of as we close out here, there's some other things that you might want to think about that we haven't talked about. And these are kind of philosophies or themes to create within your bank. We'll run through a couple of these. Trying to develop an attitude that you want to win, you want to make every loan that meets your credit standards within your market. And you also want to make every loan that meets your credit standards and exceeds your ROE targets within your market. So these are just kind of sales strategies about, how much of the available business in your marketplace you want to capture at your bank. And in setting those targets, you want to make sure that they're appropriate to your situation and that you're establishing them at the minimum level of ROE that will allow you to create improvement in the ROE of your bank. So there's a little bit of an art to defining that level. You want to make sure that your ROE targets are not set so high that they're actually shutting down the ability to gain volume within your bank. Another strategy that we've been kind of surprised to run across in the marketplace, we're finding that interest rate swaps are being used at more and smaller community banks than we've ever seen happen in the past. We observe that when that happens, it's generally happening with a fair degree of vendor support. The organizations that you work with to obtain interest rate swaps will help give you the information tools you need to adequately manage the risk factors that come along with that. But we've been kind of surprised to see how many smaller community banks are now trying to meet the needs of borrowing clients that want longer term loans by using interest rate swaps. So in some of these strategies, we understand we would probably put some of these in the general category of being fairly to highly aggressive. And to the extent that you feel that might be appropriate or inappropriate for your bank, you can maybe dial some of these back to meet your own standards. We've got a couple more along the same lines, trying to create that that personality, that knowledge base in your marketplace, that business customers know that you're a borrower-friendly bank, so that they think of you, top of mind awareness when they consider their borrowing needs, and then also being willing, think about to what extent do you have some risk-based capital where you're willing to take on some level of interest rate risk, maybe higher than you have in the past, or some level of credit risk higher than you have in the past. We kind of started the presentation out with talking about the trends in risk-taking behavior and the loosening or tightening of credit standards amongst banks today in the current environment. You may have an appetite where you can take on a little bit more of either of those two risks, take on a limited amount, take on a known amount, take it on really only in situations where you're getting paid for it. Yield should be higher in those portfolios. But those are things you can think about as kind of try to open up the spigots and bring in some greater level of loans.
All right, we had quite a few questions coming in during the presentation regarding the slides and the recorded session. Both of those are going to be available shortly after today's presentation. You will get a follow-up email, an automatic email from GoToWebinar with links to both go get the slides and view the webinar. That should be delivered to your inbox within the next hour or two after today's demo. We'll get that up there as soon as we can.
We do have a question that we've received relative to regulatory exams and regulators' view on participation loans. That's very highly dependent on your regulator, but there is, we're quite sure we agree with the kind of the perspective or the mindset that the question's coming from. There are definite limits to how far you can take that strategy. That strategy is probably of most benefit to organizations that have not really dabbled in that in the past. You might open that up as something if it's new for your bank. There are obviously upper limits that are determined between you and your regulator on how far you can take that. But we wanted to just put that out there as an opportunity for banks that maybe have not participated on that front in the past. So thank you for being with us today on this webinar, and thank you for being with us in the past. We have a couple of webinars already firmly on the calendar coming up. One on March 22nd, when we're going to be talking about 7 secrets of consistently high-performing community banks. That'll be a very interesting presentation, so please give consideration to joining us on that one. On April 20th, we're going to have another webinar talking about kind of the current update on the M&A trends. M&A has been a very active area for the last couple of years. We anticipate 2016 to be another very active year in that area, and we're going to share some case studies of mergers and acquisitions that we've been involved in here at Austin Associates.
So again, I'd like to thank everyone as well for attending. Look forward to those emails with the slides and the recording. Feel free to share those with anyone else at your institution that might have interest. If you have any other follow-up questions after today's session, here's some contact information for both Jeff and myself. We'll be readily available to take your emails and your calls. Everyone have a great day, and again, thanks for your attendance.